Thank you. It's very much a pleasure to be in front of such a distinguished audience, both in person and over the internet. It's a particular pleasure because the Minneapolis Fed has a spectacular reputation of research and sticking to facts, and also occasionally to change views when the facts change, as all economists should do. So I thought it was appropriate to talk about my views of Glass-Steagall, views that have changed over time. So I was moderately against Glass-Steagall, and so in favor of his repeal. Because, first of all, historically, the way Glass-Steagall came about was, as many pieces of legislation, a sort of a bad deal among a couple of senators that were trying to protect their own constituencies. And if you look at the evidence that was available until at least the end of the 90s, the main sort of reason why the Glass-Steagall had a justification was, number one, the risk that banks will dump on unsophisticated clients some bonds or some securities they're trying to get rid of because a borrower is about to default. And the second is that they might increase the risk of the financial system. Now, the evidence until the late 90s on this was not particularly compelling, that these two problems were big. In fact, if you think about the risk of banks damping bad credit, there is a very famous paper by Raghu Rajan and Randy Krosner showing that evidence that at least in the United States, this in the 1920s, this was not the case. What they find is there is no systematic evidence that commercial banks fool the public in the securities market, and even some evidence that markets might have rationally discounted the conflict of interest, and so the markets seem to have worked very well. Now, this is where my first doubts came about, because when I started looking at what happened in Italy, for example, at the beginning of the 2000s with the Parmalat and Cheerio scandal, it seems that banks were quite effective, actually, in transferring those bonds into the hands of depositors, turn into buyer of bonds at the right time. Now, the good news is that 15 years later, or 10 years later, they end up paying for this mistake, so maybe law that does work eventually. But my faith was maybe the Glass-Steagall is necessary in an environment in which reputation does not work very well, or the transparency is not that effective. Unfortunately, in Italy, there is a long tradition that continues to these days of banks to staff risky securities in the hands of depositors. And under the complacent eye of the Bank of Italy that sees this as a function of stability of the banking system, because, of course, if banks can fund themselves more easily and more cheaply at the expense of savers, that makes the banking system more stable. But in the United States, that was not the case, and so I think that I didn't see a strong reason for Glass-Steagall. And honestly, the evidence that there was more risk, and this might have caused the financial crisis in the 1929 and subsequent disasters, was not there. In fact, all the literature was pointing in the direction that among the banks that failed before the Great Depression, very few actually banks involved in securities dealing. And among the banks that failed during the Great Depression, a disproportionate low amount were actually banks that got involved with securities dealing. So there was not compelling evidence that this created more risk. And I have to say that I didn't see a strong argument to retain Glass-Steagall, based on the principle that I try to follow, that in economic policy, the first rule is to do no harm. And so if you don't see a strong reason to intervene, you probably shouldn't intervene. And at the beginning, when the financial crisis came, I did not subscribe with a set of people that immediately decided that the financial crisis was caused by the repeal of Glass-Steagall. And in fact, to these days, I don't think that there is much evidence that this was caused. Lehman and Bear Stearns were sort of pure investment banker, not related to others. And in fact, the rescue of Bear Stearns was made it easier by the fact that JP Morgan could buy it out because there was no Glass-Steagall. So I think that the evidence that this is what caused the problem is far from clear in my view. And as a result, I was reluctant to change my opinion. So why did I change my opinion? Is for a set of reasons that are completely different, in my view, to the traditional one, and this is what I want to discuss them with you. The first one, which to some extent we hinted this morning, but I think is very important, is that very often the perfect is the enemy of the good. So do I really think as an economist that separation between investment banking and commercial banking is the most effective way to prevent excessive risk-taking by banks or excessive sort of temptation to take risk in order to be bailed out? And the answer is absolutely not. There are a lot of schemes that do better. In fact, I wrote a paper with Oliver Hart suggesting one of those schemes, but it's certainly not the only one. There are a lot of them. However, they tend to be rather complex, not being very appealing, and at the end of the day, it's better to be safe than sorry in some situation. And is it really sort of the cost so large? And even if you add the other scheme, when it comes to something as important as entire financial stability, I subscribe to the view that it's better to have both the belt and the suspenders. So having a bit of redundancy in the system might not be the worst thing that happened in the world, especially if this redundancy is in the direction of safety. And I have to say, I have been always profoundly disappointed by the Volcker rule. I have the greatest admiration for Paul Volcker. I think he's a great man. But I think he's been taken for a ride in a political sort of compromise because the banks did not want any separation. The public wanted Glass-Steagall. So what is the political compromise? Is to give the name of somebody who has an impeccable reputation to something that cannot be implemented, and you get the cake and eat it too. And so the Volcker rule is exactly this, is something that you can't possibly implement because it depends on the intention of the trader. Now, I think that maybe in the future, the progress in neuroeconomics will make it possible with the fMRI to monitor constantly what is the intention of the traders. But under current regime and technology, I think that this is impossible. And this is so obvious that it's impossible that, in my view, I have a cynical view, but in my view, the people who introduced knew that was impossible, and that's the reason why they endorse it, because they knew it was impossible. So that's the reason why I prefer, to some extent, nothing rather than something that pretends to be great, because deflect from the need of actually creating something like Glass-Steagall. The second thing that is also being sort of forewarned this morning is the simplicity. Is very hard to introduce a piece of legislation, let's say, in the common good, because the common good, as a friend of mine told me, is the least represented lobby in Washington. And so how can you get this done if you don't have any lobby supporting you? And the only one that you could is, to some extent, the public at large. But as we all know as economists, the public at large, first of all, there is a rational ignorance. And even when they can overcome that rational ignorance, they don't get very vocal and very involved. So the only chance we have is by having some rules that people can relate to. And maybe for historical reasons, maybe for this simplicity, Glass-Steagall actually did bring some support. There was a group of people sort of pushing for it, and there was more constituency than any of the scheme that any of us has ever written as economists. So at some point, you should be humble and say, again, the best is the enemy of the good. Why don't you go in favor of a scheme that is simpler, voter understands, and maybe can actually support? But there are some other advantages of simplicity. Is the simpler a norm, the fewer provisions there are, and the less expensive it is to enforce them. The simpler is a rule, the more difficult it is for vested interests actually to get away with distorting some technicality that are hidden in page 942, but they really undermine the entire system. In researching for my second book, A Capitalist for the People, came across a writing of a former regulator that was honest enough to say that whenever he wrote regulation, on purpose was leaving some loophole to make sure that some people could drive a truck in it and sort of change the regulation to their own advantage. So the more complex a piece of legislation is, the easier it is to find loopholes, the easier it is to completely empty it or to attack piece by piece. Because these days, regulation is first passed with a big noise in Washington, and then every day we have the Chamber of Commerce suing on the little piece of it. At the end of the day, there is nothing standing. Actually, I have to say, the only thing that is standing is the bad part of regulation. Because that part, nobody, because is sort of benefited somebody, a concentrated interest, the concentrated interest will defend actively, so will never brought in front of a court and challenge. And so the risk of complex regulation is that it starts as a quasi-decent deal and ends up as a terrible deal at the end. And that's the reason why I think that simpler is better. Then there is a third fact that I have to say is more of an observation, but I think is an important observation that I wish somebody actually follow up and documented it better. And the observation is the following. If you look when financial markets develop, the equity market and the option markets, was during the period of Glass-Steagall. Then Glass-Steagall was removed, and the new instruments that are traded tend to be sort of derivatives and stuff that goes over the counter. Why? Because the competitive markets benefit everybody, but nobody one in particular. So if I'm trying to create an institution like trading some instruments, I want this institution to be captive of few players that reduce competition and increase margins. And that's exactly what derivatives over-the-counter markets were about. Now, with Dodd-Frank and a lot of effort, we've tried now to reduce this. But it's still the case that they're not as competitive as the option market, the future market, and the equity market. And even in the equity market, you see there is an erosion because the gray market is becoming more important and the market for institutions is becoming more important. Why? Because you want to take away from transparency, equal access, and equal information in order to have few players, high margins, and high profits. And the high margins and high profits finance the lobbying to support and maintain that system. Now, this is true historically in the United States. It's also true cross-sectionally in other countries. What are the countries where the equity markets are less developed? Other countries with a very strong banking system. Think about Germany. Why? Because sort of banks don't want to have a competitor, and they're trying to either sort of make it difficult to develop or completely capture it in a way that makes sure that they don't take away business from their core business. So because I like markets, I think that it might be useful occasionally to have restriction that promotes the development of market. And I think that ironically, Glass-Steagall was something that promoted very heavily the development of the equity market in the United States. And I think if we want other financial markets to be traded and traded efficiently, restriction will deliver that in the best way. The fourth point is actually about resiliency. Remember, in 1987, there was a stock market crash. Nothing happened after that to the economy. Now, certainly that was also thanks to the prompt action of the Federal Reserve, and in particular Alan Greenspan. However, one reason is that at the time, the stock market was completely isolated from the banking market. Banks did not own any equity. They were not heavily trading to equity. Any loss of the equity market did not affect the banking sector and the real economy. In 1991, there was a big banking crisis, but the stock market and the market for commercial paper was doing actually fairly well. And so we had a recession, but was, by recent standards, a very mild recession. Why was it a mild recession? In part because part of the financial system was working completely unaffected by the rest, which is by the banking crisis. So in a sense, if you think that you can have disturbances, and these days it's hard to argue with the fact that we have disturbances, be there bubble, be there sort of excessive speculation, be there fraud, be there real estate crisis, is not bad to have, again, a belt and a suspender, to have a banking system and a financial market systems that operate in a fairly sort of independent way, so that when one is impaired, the other one is still fully functional and capture some of the slack. Of course, not all the slack, that would be impossible, that would be a dream, but at least some of the slack. And part of the problem that we observed during the great financial crisis was the fact that this separation did not exist. And so losses that initially were losses just in sort of the mortgage market became losses that involve the banking sector. So the correlation between the two became much stronger, bringing both down at the same time. So a separation is a kind of way to create two independent systems that operate separately, and as a result, they're more resilient. But the last point, and in my view, probably the most important one, and the one that is basically never mentioned, is an issue about the political power of banks. I studied for many years sort of the evolution of regulation in the United States and banking regulation. I always thought that banking regulation until the early 90s was pretty crazy. In a sense, the fact that in Illinois, banks from northern Illinois could not lend to southern Illinois and vice versa is as sort of crazy as you can get from an economic point of view. However, what I miss by studying this stuff is that some craziness aside, there was a sort of redeeming feature of all this, which was a fragmentation of the banking sector that led also to a fragmentation of interest and fragmentation of the political power of the banking sector. So what could be a good counterfactual test? A good counterfactual test is the consumer bankruptcy reform of 2005. If you read the accounts of how the reform took place, they say historically there were different constituencies and it was a long fight, we reached a compromise, and then we got the reform. In 2005, you had a united front of all the banks dictating what they wanted, and that became law subsequently. Why? It's because in the meantime, there had been a merger of banks, so the fragmentation of interest became less important, and also at the same time, there was a merger across specialization. So you had insurance and you had investment banks, you had commercial banks that in the past were fighting and lobbying against each other, lobbying united because they have the same interests. And competition is a source of freedom everywhere, but in particular when it comes to lobby, because the public at large is sort of uninformed and unmotivated and underfunded. So the only way in which the public can get away is if there is a fight between different interests. The Becker model of efficient lobbying is related to competition in the lobbying sector. If the interest of concentrated interest is too homogeneous, you have something that not only is bad for the public at large, ironically, at least in this case, was bad for the very financial industry that pushed it. Why? Two examples. Number one, the way in which made it more difficult to dismiss credit card debt, which I think was not a bad idea to make it more difficult to dismiss credit card debt. But one of the unintended consequences is consumers who couldn't dismiss credit card debt ended up defaulting on the mortgages. Before, they could default on the credit card debt and the mortgage was safe. When they couldn't default on one, they ended up defaulting on both. And so during the financial crisis, that made the financial crisis worse. Not to mention what was mentioned earlier this morning, which is the special treatment of derivative in bankruptcy. What they obtained during that was, number one, the extension to a number of securities outside Treasury of the special treatment that they had in bankruptcy. So this special treatment of repo made the repo with dubious quality security much more diffuse and destabilized the banking sector. And you know, I sort of spoke with a very famous hedge fund manager, and he told me that even he had no idea of this treatment of derivatives in bankruptcy until a few days before Lehman went under. Okay? So these rules are so cryptic that nobody knows them. They are pushed through by a small sort of group, and they get approved over the interest of the public at large. Why? Because there is not a fragmentation of interest. So one of the things I've been pushing, with zero success so far, but you know, I keep pushing, is to have a political view of the antitrust. Economists have reduced the antitrust to an analysis of consumer surplus and producer surplus. And what I want is to bring it back to origin. The first antitrust law, 1890, was not passed because people understood that there was an inefficiency triangle, the Harbinger triangle of monopoly. No, was pushed because they thought that power corrupts and absolute power corrupts absolutely. And concentration is bad when it's political power, when it's economic power, but doubly bad when it is a concentration of political and economic power in the same hands. And maybe this took place with the help of some crazy people. Started with Andrew Jackson, that now will leave the $20 bill, and other sort of strange folks. However, there was some value in this craziness. And all this anti-New York feeling that permeate American politics had a big advantage to make the financial industry more accountable, more fragmented, less powerful. Now, we have lost all of this in the years leading to the financial crisis, and has only become worse after the financial crisis. The financial crisis has made sort of banks more concentrated, interests more concentrated, and bankers more powerful. And I don't want to need another crazy Andrew Jackson to arrive to a better system. We should actually think more carefully about what are the political consequences of a merger. When you merge two institutions, not only you might sort of reduce consumer surplus, in addition to that, you create an enormous lobbying pressure that is more difficult to resist. And so this should be an argument that should be evaluated in every antitrust case, but in particular in the banking sector, because of the importance of the banking sector and also the tradition of power of the banking sector. And so I think ultimately the Glass-Steagall, or some form of Glass-Steagall, by fragmenting the banking industry, at least along specialization dimension, if not in terms of size, what it will do, it will create more sort of a competition in Washington among different vested interests, and that competition will, in principle, produce better regulation. So my view is not that Glass-Steagall is the perfect system. By all means, I can tell you there are many more of that. But the combination of factors led me to believe that today we'd be better off if we had a Glass-Steagall system rather than a Volcker rule. Thank you.
Thanks, Luigi. Great talk. I have a question about the last 2 points. So the resiliency point, you say there's more resiliency, and you assume that if you keep it separate, then maybe one doesn't work and the other works. But it's also possible, keeping them separate, you reduce resiliency, because if the two are together, if one shock in one side, the other can help. And so, and the political power seems to make the argument, if you let them join, then they join forces, they're one thing. So that suggests that I'm not so sure that two points are both operating on the same point at the same time.
Yeah, I take the point that Thomas raised earlier. I don't have a model to prove that, okay? So if that's what you're saying, guilty as charged, okay? But because I do a lunch speech, I thought I could get away without a model. But I think that, in my view, the logic is pretty clear. Yes, for small shocks, probably having a full transmission is better. But for large shocks, having a contamination is much, much worse. And because we're very risk averse, in particular against extreme negative shocks, that's the reason why I think that having some separation is good.
I rise to defend the record of Paul Volcker with respect to the Volcker rule. The Volcker rule is a very simple rule, as conceived by Paul Volcker. It was simply a rule that banks were prohibited from trading, engaging in proprietary trading for their own account. And that if a banker can't tell when he's engaged in proprietary trading for his own account, he doesn't deserve to be a banker. Now, I drafted the first draft of the Volcker rule. It was 3 pages. It turned out in the legislation, turned out some 30 pages in a 1,000-page bill. And then the regulations turned those 30 pages into 300 pages of regulation. So if it wasn't Paul Volcker's fault that it became extremely complex and difficult to administer with all kinds of potential loopholes. That was a result of the political process. But the intention was very clear, and if the intention was carried out, it would be very simple to administer.
Thank you for the clarification. And I think it's very humbling to hear that you start with the best intention and you end up with the worst outcome. But it was not my intention to sort of not recognize the good motivation of Paul Volcker. I think that the way you want to think about when you do regulation is by following this rule that I call the alcohol test. When I was a little kid, my mother, and I got injured, my mother would always use alcohol to disinfect the wound, even at a time where it was proven that there were other disinfectants that were much better than alcohol. And I was trying, are you a sadist? Why are you doing it? No, this is the only way I'm sure that actually I do the job, because when you start screaming, then I know that the alcohol is effective and is disinfecting, okay? I think this should be the rule for regulators and legislators when they propose some rules. Because if they see the regulator not screaming, means that there is a problem, okay? The only way, the regulation by definition works only when it hurts somehow. If it doesn't hurt, does not do the job of disinfecting. So when you see that bankers joining too fast on the Volcker rule, then you know there is a problem. And so you need to fix that earlier. And second, now again, I don't want to use it against Paul Volcker, but in the future, I think we might have to have the option to withdraw your name from a rule. Say, the rule has been deteriorated so much that I did not recognize the rule as mine anymore. I think that will play a role. Now, I'm not joking. I think it's true, because his name is so impeccable precisely because of the person he is that has been used. And I think that you should retain the right to take away your name from a rule.
So my question is very closely related, and that is, given that the Volcker rule was meant to reinstate Glass-Steagall, it was thought of as a 21st century version of Glass-Steagall, could you say a little bit more about how you would do this separation? What would you call an investment bank that can't be part of a commercial bank?
So now, I'm not very good on the plumbing, especially in front of such a distinguished audience. I think that I'd be very simple and say that the trading of securities, the underwriting and trading of securities should not be part of what a normal bank does. And you should have a separate entity that does that. It's a very valuable activity, but in that, Paul Volcker was absolutely right. I don't know why you want to do it that with insured deposit. And so keep the two separate.
That's a pretty small piece of what a contemporary investment bank does.
Of course, when I say trading of security, I mean also underwriting of derivatives and sort of all the stuff that comes with it. So I'm not as strong as John and wants the banks to do only sort of to be 100% equity finance and do only sort of lending. No, what do you? But okay.
I would imagine in this political environment that there'd be a lot of receptivity to your idea to consider the political implications of mergers, not just the direct economic implications, not just for the financial services. I can imagine people viewing the oil and gas industry maybe as saying they have too much power, or any number of industries. As you've explored these ideas, is there any receptivity? I mean, are people, I would imagine it cuts across party lines.
I would imagine the same way, but I sort of proposed this in my book in 2012, and the idea is out there. I honestly have not gone and lobby various politicians to try to force them, and some of them I don't want to go and lobby them, so maybe that's part of the problem. But I think that my vision of the world is precisely because there is a lot of resentment out there. It would be a reasonable thing for a reasonable platform to have a proposal like that. And says my model is actually Theodore Roosevelt. Theodore Roosevelt was not a populist, but understood very clearly the pressure that was coming from the populist movement and also the risk of not understanding some of those motivations. And so was able to incorporate that in a way that made the system overall better. And unfortunately, we see plenty of populists out there today. We don't see a Theodore Roosevelt able to sort of channel that populism in a productive fashion.
Is there, around the world, are there any examples of countries that take this view, consider this analysis when they consider approving mergers? Are you aware of any?
No, I'm not familiar with anybody doing that.
Thanks.
Luigi, let me just push back on this point a little bit. You want the federal judge and the Department of Justice to say, no, I disapprove this merger because even though it's economically fine, the joint company will be too politically powerful and possibly of the wrong party. This just sounds like a politicization of economic policy and a use of federal government power to further partisan ends that is just very dangerous.
Now that I know that you want to nationalize the entire banking system, I think that my proposal is very moderate by comparison. But most seriously, I think that I don't care about the party. Here we're not talking about Democrat or Republican, right or left. We're talking about interest, okay? Economic interest, which we understand very well. And we know from economics that concentrated interests have a disproportionate amount of power versus diffuse interest. I'm not saying that our diffuse interest is zero, okay? It's not zero, but it's not very large. So 100 years ago, people would say, how could you possibly compare the surplus of consumers versus the surplus of producer? And Now you're saying, how can you possibly compare the power generated by a concentration of certain interests versus the diffusion of others? And I think it's possible to do it if we put ourselves to in a way that is as objective, I would say, as the consumer surplus. Now, you can say that even the consumer surplus analysis is politicized, but I don't know why it sort of is not. And second, you can have remedies. You have remedies for consumers. Why don't you have remedies from a political point of view that, for example, you restrict unilaterally your willingness to lobby Congress or to finance campaign or to finance think tanks that produce only research in a particular direction? That's very important. We want more of that.
Hello? Yeah, sorry. So, I totally agree with the importance of the political economy of antitrust. I would just offer a slightly different perspective. I think I like your motivation. I'm not sure you reached the logical conclusion for two reasons. If you look at banking, what's the peculiar feature of banking? Well, so it has become more concentrated. And also, I think the missing keyword here is entry, which is there is very little entry in banking. There is very little entry because it's very hard to take over a bank if you're not a bank. And it's kind of hard to create one that is large enough to compete in the market that you care about. And therefore, I would conclude that and then if you think about the political economy, if you have a market which is too concentrated, there are really two ways to make it more competitive. You can break up the incumbents, but I think that's kind of setting up the most uphill battle. There's an easier one, which is to encourage entry. So to me, the logical conclusion of all of that is that we have one window of opportunity now and for the next 10 years, which is the fintech business. And if there is the only thing that, if I had to choose only one thing that regulators should be doing, which is make sure that entry is possible in all lines of businesses by these new fintech companies. And that should be priority number one. And if you think about it, I think politically it's still going to be a fight. It's still not going to be easy. And the incumbents are going to try to buy these companies quickly. That's for sure. But it's still going to be a lot easier than breaking up the incumbents. And to me, the political economy is still going to be marginally better. If you look at two countries you know well, France and Italy, the equivalent of the banks in our country is called the taxis. And every time you want to do something about the lobby of taxis, they block the streets, and that's the end of it. And governments have tried to do many things, never done anything. The only thing that actually is doing something now is Uber. Why? Because it's a new entrant. So it's just harder, and they are trying to block it. But still, at the margin, you can see that this fight is a lot easier. So my sense is that in banking, rather than say we need to have Glass-Steagall, the solution is we need to have entry by new firms, and if they can do real-time pricing and settlement like John was proposing, well, then that's going to be a pretty good alternative to the payment system, and then you don't have to worry so much about the banks anymore.
I completely agree that fintech is a big hope, and we should encourage and try to make it as feasible as possible. But the two things, number one, are not in contradiction. In fact, they're quite complementary. So I'm actually writing my first case on a peer-to-peer lender in Chile, Cumplo, that got started by a Stanford MBA. And immediately after he started, he got a criminal investigation from the banking superintendent. And this criminal investigation was actually instigated by the other banks and said, he's violating the banking law. And I now have court and say that the banking law was designed to make sure that nobody was coming in. Okay? And if add insult to injury, being Chile and being a small place, they're all friends of each other. They all know each other. And so his cousin was one of the biggest lawyer, and he asked his cousin to defend him. He said, no, because I have too much business from banks. I don't want to defend you. So if you are a newcomer, not only you have the legislation against you, you have also the sort of industry that goes around regulation that is highly dependent on the incumbents. And again, the more concentrated all this stuff is, the more difficult it is to break it apart. Now, in the case of Cumplo, he was saved by two facts. Number one, that he knew the president, because in Chile, all the people who matter know each other, okay? So they went to school together. So he knew the president, and he got an article on The Economist saying, you're trying to make Chile the startup economy, and then the first startup you do, you're actually sending the police with the machine guns to arrest them. That doesn't seem like a great thing for the future of Chile. And after that became untouchable. But if it wasn't, and now is a pretty big sort of peer-to-peer lender in entire Latin America. So if sort of you don't have this thing in place, if you don't have trying to break the power that the banks have over regulation and the political system, the fintech industry will never come in. So in Italy, they consider sort of the new peer-to-peer lender as very dangerous, while they are the real dangerous banks that they didn't look at them, okay? But so all the attention is, if you sort of don't follow the normal thing, you're not dressed with a suit, and you don't come from the right family, you're really dangerous, so we want to stop you. But if you are dressed with a suit and you come from the right family, you can steal money, but you're fine, okay? So that's the risk that we're running in this. And why? Is because there is too much sort of capture of regulators by few powerful banks. So the idea of fighting on both fronts, I don't think is in contradiction, is the same battle, and you have to pick both in order to win half of it.
Didn't they put the Uber execs in jail in France?
Yes, I think that they might. Uber uses a very interesting strategy, which is to basically do something that is illegal, and then trying to create enough sort of consensus in the population so that the stuff that is illegal becomes legal. Okay? I don't think it's very doable in the banking sector. And two, depends very much on how organized are these constituencies. So the reason why Uber, this is a fascinating political economy thing, because the reason why Uber succeeded so well in the United States is because in the United States, the medallion are owned by investors. There is a guy in New York that owns 50% of the medallion in Chicago and New York. So investors are sort of can take losses, and they're not, because a small investor in the grand scheme of things, they don't have enough power to change every city. In Italy or in France, the cabs are cooperatives. So, and they are owned by the various cab drivers. The medallions are owned by the cab drivers. And many of them, they did not benefit from the system because the guys who started retired and sold them the medallion, and so they took a mortgage in order to get a medallion. And if you sort of liberalize Uber, these guys go bankrupt. And now you have 10,000 people in Paris that are going to go bankrupt tomorrow. They create an enormous political force, okay? But that's because of the initial allocation of property rights that makes it more difficult to do the political economy game that Uber does. In general, the banking sector, there are some very well-positioned guys that know the law much better than everybody else and make sure that the newcomers don't come, or if they come, they need a lot of sort of local bricks and mortars because they are afraid to lose all the value they have.
Didn't you just contradict yourself? Didn't you say 10,000 little cab drivers have way more political power than one big owner of all the medallions?
Yes, because there is no doubt. I said it's not true that the diffuse public has no power. In fact, you ask any politician, they say that if the choice is between vested interests and the voters, they go for the voters all the time. And even after they retire, so they have no sort of things to defend. The problem is that most of the time the voters are not mobilized. When is the last time that you went and called your representative in order to change the bankruptcy law?
10,000 banks have more power than one big bank? I don't get how, I don't see how you're doing it.
Sorry, say it again.
10,000 cab drivers have more power than one owner of all the medallions. Then don't 10,000 banks?
Oh, if their
Owners have more power than
if
one
the
owner of all the
interest is
banks?
completely aligned, absolutely. But it is not completely aligned. That's the secret. In the case of the cab driver, is completely aligned. They need to protect their rent, otherwise they go bankrupt. And that focuses the mind like nothing else. Yes?
Yeah, I like the focus on the political economy, but it seems to me you need to think it through a little more. So if you have a segmented system, banks and investment banks, commercial banks, insurers, each of them is going to capture their own regulators. And if you think about the banking regulator, their incentive is to keep non-banks out of banks, but they want to allow the banks to go into other systems. So you have a sort of mixed incentives there. If you sort of look at our history, the first few decades after Glass-Steagall, the sort of equilibrium was they each kept separate. Beginning in 1970 or so, you see them moving in the other direction, each regulator starting to allow their entity to move into the others. And you got a sort of cascading system of deregulation that eventually leads to Gramm-Leach-Bliley. So even if you want to keep the separation, how do you keep the political economy in sort of those first few decades after the Great Depression, instead of a sort of competition to allow your own entities to move into other fields, which is what each regulator wants to do, allow their own entity to move into the other areas.
I think that's a very good point. How this fragmentation evolves in a dynamic game over time is a very interesting question to which I don't claim to have a solution.
Yeah. Jim Bullard, St. Louis Fed. So how should I think about cross-border mergers? It seems like what you're saying is you wouldn't allow mergers within a country because of the political power argument. Are cross-border mergers okay? Is it okay if Mitsubishi Bank buys something big in the US and then they're not politically powerful, or are they politically powerful?
Oh, between keeping size constant, between an in-market merger or a cross-market mergers, a cross-market merger any time of the day. I think that having, I know quite well the Italian experience. Every time the merge internally was a disaster, every time the merge across was much better. And I think that we need, in Europe, many more sort of across-market mergers. In the United States, you have a larger sort of size, so it's less compelling. But still, I don't see what is the problem of having sort of across. It's a problem for the regulator because you have to negotiate with the other regulator. But overall, they're going to have less political power than somebody that controls a large chunk of the industry here, whether this is banking or any other industry. So I'm not against size per se. I'm more concerned about size in a given location.
So Barclays goes and buys a lot of banks across Europe. They don't become powerful in all of those countries?
I'm not saying that they don't become powerful at all. I'm just saying that if the choice is Barclays buys HSBC or Barclays buys BNP Paribas, buy much better Barclays by BNP Paribas. I'm not saying that they don't increase power. Absolutely, they do, but they increase more if Barclays buys HSBC.